I'm Charles Buck, President and CEO of United Church Funds, or UCF. Thank you for joining us today, and thank you for trusting us to be your partners in faithful stewardship. If I could have the next slide here. These are reasons on this slide why our clients choose UCF, and chief among these is our commitment to investing with a mission right at the top. That's our guiding theme at UCF. And if we were to spin it out just a little more, I think we'd add investing for your mission. Investing for your mission is what we consider our basic purpose. It's to help you fund your mission. This last year, however, has made that pretty challenging. The economy, markets, politics, world events have all contributed to a volatile year that have continued into this quarter and probably into the next and maybe beyond that. We understand these concerns. Worry and anxiety have spread wide and run deep. So these town hall updates, we believe, are important, not just to keep you informed with what's happening, but also for us to reassure you that here at UCF, we pay attention to all of this while maintaining a long-term perspective. We keep the long view, constantly examining and adjusting strategy along the way. We want to ensure that our clients can fund their mission, God's mission, continuously and for generations to come. On the next slide, you'll see our program for today. Stacy Pettis, our executive for institutional relationships, will kick things off by sharing the latest here at UCF. Matthew Illian, Director of Responsible Investing, will follow with updates on our responsible investing efforts. And then we've got a really special guest for you today, Rachel Kahn-Troster, who is the Executive Vice President of the ICCR, one of our very important partners in the responsible investing work that we do. After that, the institutional relationships team of Matt Wagner and Stacy Pettis will be in dialogue with our investment team from the pension boards. That's Dave Klassen, Lon Kai, Minati Dhanaraj. They're going to talk about quarterly performance and what they see happening in the economy, capital markets, and world events. We'll leave time for Q&A at the end. As questions arise through all of this, I want you to throw them into the Q&A box. We'll get to as many as we can. And if we can't, or if you have questions that come up later, we invite you to be in touch with us at any time by email or phone. Finally, I want to mention out loud and say thank you to Debbie Wibowo and Adam Sank of our marketing and communications team. They are the ones who really make these UCF webinars happen. Thank you so much. Stacy, you have the floor.
Thank you so much, Charles, and thank you all for joining us today. We are excited to share some of our organizational updates, one being the launch of our new client portal and our new account statements. Please be on the lookout in the coming weeks for detailed training on the new platform. Our UCF Board of Directors is committed to increasing manager diversity, and there are ongoing efforts related to due diligence of diversity, equity, and inclusion regarding reporting of our existing managers on our platform. And our investments team continues to search for investment managers of historically underrepresented groups with a focus on Black-owned or Black managers. And we look forward to sharing more details about that with you in the future as we look to add them to our domestic portfolio in the future. We also kicked off a climate justice task force, and we're really excited about this as we will be offering a report to the 2023 General Synod on progress towards climate and sustainability investing initiatives, and making the connection between climate justice and environmental racism. And we are also looking to envision next steps for our Beyond Fossil Fuels Fund option, in which many of you are currently invested in. As the end of the year is approaching, our staff is excited to be back in person with many of you in meetings, but also we will be attending, both myself and Matthew Wagner will be attending the Authorizing Ministry 21 conference in December, the 6th through the 9th in Atlanta, Georgia, and then our Director of Responsible Investing, Matthew Illian, will be also attending the Responsible Investor USA conference in New York City, the 6th through the 7th. So we just wanted to share those highlights and updates with you. And now I'll turn it over to Matthew Illian, who will share some more information regarding responsible investing. Matthew?
Thank you, Stacy. The theme of my short talk here is that the work of sustainable and responsible investing is never done. We'll go to the next slide. We'll share a few updates with you. The first area that we wanted to update you all on is our work to engage with corporations on their direct and indirect ties to the Russian economy. And as you know, we did an assessment back in February when the invasion happened of our exposure. It was very low. It was well below 1% to companies domiciled in Russia. But we're now pushing that further to look for indirect connections that companies have to the Russian economy and to the military state there. In particular, you'll see two examples. We're working with our human rights consultant to engage with U.S. banks, in particular JP Morgan, on their financing ties in Russia and a number of state-owned enterprises, and asking them some hard questions about how they, plan to kind of either draw down or hold, those engagements and financing responsibly. And then also, we were also involved in some engagements around tech companies, in particular Analog Devices and Texas Instruments, that have been found to have components in detonated weapons that the Russian military have used. And so there's some upcoming conversations there around the know your customer responsibilities that these companies have when their tech is being sold, and there's particular types of tech that is required to have more intensive due diligence, and so we'll share more updates there. But we're now moving to this indirect phase. Next slide. Stacy mentioned the Climate Justice Task Force launch. We just wanted to show you the 6 members who are part of that task force. Thankfully, Stacy is part of it. Reverend Penny Lowe's, Reverend Steve Silver, myself as staff to that. Reverend Dr. Brooks Burnt is our UCC Environmental Justice Ministers on the task force, as well as Brian Thomas. And the mission there is to really update our climate justice commitments across all funds with a special focus on the BFF funds, and pay particular attention to those communities most impacted by pollution and the transition to a low carbon economy. Next slide. We also wanted to share that we continue to engage with the dollar stores. You'll see Dollar Tree and Dollar General listed there. And we're calling on these companies to improve employee safety measures, pay attention to living wages. Both companies have been cited by OSHA, or the Occupational Safety and Health Administration, for over $1 million fines. And so we're asking them how they're going to avoid those types of fines in the future, as well as protect their workforce. And right now it's getting the expectations are rising on companies, particularly with frontline workers, to both pay higher wages and ensure their employees are protected. Lastly, on this slide, we wanted to make sure that you saw on our blog a update with our engagement with FedEx. In partnership with the pension board, we worked with FedEx, and they agreed to additional disclosures around their lobbying, in particular their connections between how their own statements to support the Paris Accord and a net zero are aligning with their lobbying, because often what we're seeing is companies are saying one thing and doing another. So we're asking for them to disclose to ensure that they're paying attention to what both hands are, what they're saying and what they're doing. And we'll go to the next slide. We have a trivia question for you. Charles mentioned that we're going to have a special guest today, and Rabbi Rachel comes from ICCR, and we do a lot of work with ICCR. And just for fun, we thought let's poll our audience here. So what do you think ICCR stands for? Is it investing corporate cash responsibly? Is it Investor Center for Corporate Research? Is it the Interfaith Center for Corporate Responsibility? Or lastly, is it isolating cataclysmic carbon rotation? So which of those do you believe ICCR stands for? And as soon as we get enough votes, we'll see where we stand. All right. I was really hoping somebody would vote for the isolating cataclysmic carbon rotation, but it looks like we're pretty much on track. It's the Interfaith Center for Corporate Responsibility, and we are a founding member. It's over 50 years old. We've so much of our responsible investing work is in partnership with the ICCR peers and colleagues. And on the next slide, I want to just share a quick introduction to Rabbi Rachel Kahn-Troster. She is Executive Vice President of ICCR. She's the primary internal manager for the organization and partners with the CEO in developing strategy for the organization's vision and mission. Before joining ICCR, Rabbi Rachel spent nearly 14 years at TRUA, the Rabbinical Call for Human Rights. And at TRUA, she organized against US-sponsored torture and the war on terror. She also initiated campaigns against human trafficking and forced labor, to end solitary confinement, to fight against mass incarceration, and for human rights in the occupied Palestinian territories. She is a colleague in heart, and joining us live, we have Rabbi Rachel here. And we are delighted to have her. And I wanted to ask a few questions. So first of all, Rabbi Rachel, thank you for joining us. We're delighted to have you.
Well, thank you for having me. It's really wonderful to be able to speak to your members. As you mentioned, United Church Funds was a founding member of ICCR and has been a key partner of ours for the 51 years of our history.
So can you share with us, just to get us started, a little bit more about ICCR? Who are the members? Currently, it's evolved over time, who support the mission.
Right. So ICCR members are institutional investors, faith-based asset owners like yourselves, values-based asset managers, as well as nonprofits. We work with unions, stakeholder groups. It's really, I think of ICCR as a community of people really of organizations and their communities who are dedicated to the idea that we have to, hold up our values and hold corporations accountable for their impact on people and planet. And that really is a partnership. ICCR members work together with our staff to develop strategies. Many of our members do a lot of things to make the world a better place using their resources, whether it's where they invest, where they screen out, and also filing shareholder resolutions. But ICCR is the place where we collaborate on company engagement. And I really think it's unique that we're all working together to further the mission of holding corporations accountable. I've seen a lot of real change through our ability to partner with stakeholder groups. Many of our members, like your organization, because you're faith-based organizations, you have strong connections to communities on the front lines, and that we can be another voice for getting the issues of communities and workers and stakeholders in front of companies. And ICCR members are really working on the major issues of our time, a huge amount of work, obviously, on the climate crisis. We work on worker rights, both here in the United States and also in the supply chains of companies. So that's largely with workers overseas. And we also have a big program around health equity. And we talk to corporations as well about their lobbying and political spending, which feels, with the election a week away, feels very live, thinking about how corporations influence our politicians as well as the political debate.
So thank you for that. And I think we'd love to know what led you to join ICCR. How did you get involved? What was your how did you find ICCR and want to become involved in the leadership there?
I think my being here at ICCR was a path that was more than a decade in the making. As my biography mentioned, I started off doing grasstops faith organizing. I was working in the Jewish community to activate rabbis and other Jewish leaders on human rights issues. And as mentioned, one of the campaigns I founded was the work on forced labor. And that really meant if you want to end forced labor, it's not just about helping individual workers in bad situations, but it really meant to think about the role that big companies at the top of supply chains have on creating abusive situations at the bottom. But one of the challenges that I felt as a moral leader, again, I am a rabbi, was that many of the conversations about ending forced labor at the time, this was say 2009, 2010, were more about helping consumers buy a better product rather than actually helping the people or creating better lives for them and ending the exploitative conditions. And that felt really wrong to me, both because it didn't really solve the problem and because it was product focused rather than person focused. I've always said, like, it's not, the tomato or the chocolate or the clothing that's created in the image of God, it's the human being who produced it. And about a decade ago, I was fortunate to make two really transformative relationships. One, I met my colleague at ICCR, Reverend David Schilling, who was running the work on fighting forced labor. And he showed me again how shareholder advocacy was an important tool for holding corporations accountable for the conditions their workers face in supply chains. And I also began working with a coalition of Immokalee workers, which is a grassroots farm worker coalition in Florida, who is actually a very long time and important coalition partner of the United Church of Christ. And as part of their strategy to end human trafficking and poverty wages in the Florida tomato industry, they were also doing shareholder advocacy. So these two pieces of my working world came together, and I was able to work on behalf of Coalition of Immokalee workers with ICCR to do shareholder advocacy. And it really enabled me to both see the work from both sides, how faith communities were mobilizing to uphold their values through shareholder advocacy, and also how that mattered to the communities who were most affected by low wages and human rights abuses. Over time, over the next decade, I got to see more of the breadth of ICCR's work. And so when the opportunity came to work at ICCR to help build and support an organization and community, that had really opened my eyes to how transformative work was possible. And also for me to learn more about a field I wanted to devote myself to, I really jumped at the opportunity. So I've been at ICCR a year and a half, and I have learned so much and really been blessed to get to know our members like United Church Funds.
It's great to hear how your commitment to justice is really led you to this place, and how that work now you're helping steward all of these partnerships. How many members are around in ICCR? Do you know that offhand? We
have over 300 members, okay. Organizational members representing $4.3 trillion in assets under management. So we speak with a big voice, a big moral voice. And I think those two things really make corporations listen. I think they understand the communities that we represent and the value, that we are interested both in their long-term, success as a company from a business perspective, but also that we make a moral case for doing justly.
Well said. Well, my last question for you goes back to the work that we're doing with the dollar stores, which is part of an ICCR initiative called Advancing Worker Justice. This is a new initiative, and so I wanted to see from your perspective, why is advancing worker justice important now, and any thoughts you have on personally on this new initiative?
I think that this is such an important initiative, and we're really grateful for UCF's engagement and leadership here. Worker rights has been a long time thing that ICCR has engaged with companies on, but coming out of the pandemic, when we began to hear this language of essential workers, and yet we know that so many essential and frontline workers are not being paid a living wage, they don't have paid sick leave, or they lack freedom of association. I think it showed that there was a strong disconnection sometimes between the values companies were professing and the ways that their workers were being treated. You can't talk about corporate values and then not pay a living wage. And so this was an opportunity for us to consolidate our work on freedom of association, paid sick leave, and living wage, which are really core to creating workplaces of dignity and respect, and a really critical place for investor intervention, because they can say, we think this is not the company we want to see. It's bad for your long-term value. It's bad for who you are in the community. And so to make this a priority program area for us right now, I think has been something I'm really excited about. And you can see, like, you can read the headlines about the Starbucks organizing around the country, and then you can see the way that ICCR investor members are working to support the workers, or the work that is happening with Dollar Tree and Dollar General. There's such a strong connection in this work area between the conversations that are on everyone's mind and the need to hold corporations accountable, and then the fact that ICCR's community can you can do these company engagements and really begin to affect change. So I think it's really exciting to see this work come to the forefront.
Well, as I said at the beginning of this, the work of sustainable and responsible investing is never done, but we thank you for your leadership and for joining us here today. We really appreciate it.
Thank you so much for having me.
All right, with that, I'll turn it over to my colleague, Matt Wagner.
Greetings, everyone. Thank you, Matthew. Thank you, Rabbi Raquel. Our dual mandate at United Church Funds is just integral to our overall investment strategy on behalf of our clients, and to be a member of and a partner with the Interfaith Center for Corporate Responsibility is a really key part and a really strong relationship for us. And so I'm glad we were able to highlight that for our clients and those joining on the call. And welcome, everybody. I'm going to kick off with a poll question. This poll question has to do with the financial outlook of your church or organization. Given the market downturn and rising rates, rising inflation, you have several choices to best describe that financial outlook. So we'll give everyone a minute to respond to this poll, and then we'll move on with market updates and Q&A with our investment team. Okay. I think we're waiting for a few more responses here. And here are the responses. So about 50% of you say we have some concerns, but are confident there will be a recovery in the next year or two. About 20% have significant concerns and are reconsidering spending options. And a full quarter say that you are already dipping into endowment funds in order to meet operating costs. And so we certainly understand those concerns, and we appreciate your response to that poll. As we switch gears in the presentation tonight, I'm going to be joined again by my colleague, Stacy Pettis, as well as our investment team, led by Dave Clausen, along with Lon Kai and Manothi Dhanaraj. And we'll be hearing from them in just a moment. This slide gives you what looks like a very wordy overview of some of the things that are certainly on the minds, not only of our investment team and our institutional relationship staff, but also on the minds of our clients. And as most of us know on the call, over the first 3 quarters, we've experienced a very challenging market, both in equities and fixed income, with the S&P 500 essentially retrenching just above the starting 2020 levels prior to the pandemic, and with bonds under severe pressure due to rising interest rates. There are a number of factors, economic factors, that we are certainly keeping top of mind as we make investment strategy decisions on behalf of our clients and within our portfolios. Most notably, inflation, as we said, interest rates, as we said, but also the macro risks, the global macro risks that you can see there in bullet 3. Global tensions are high, not only with the conflict in Ukraine and the Russian incursion there, but also between U.S. and China, and in other places around the globe with our fossil fuel partners and suppliers, as well as other places. And so there are a lot of moving parts in today's market, and certainly we're glad to have some experienced hands at the tiller as it relates to managing the $900 million with which we've been entrusted. As we switch slides here to the next, you'll see some of the index returns. And I won't spend too much time on this slide, but suffice it to say that rates have, as you can see on the right, rates have moved up significantly. As of today, you can earn 4.7% on a 2-year Treasury note, which is more than what you can return on a 30-year note, which pays you about 4.18 or so. The 10-year sitting at about 4.15 with the 10-year. And equities have been, again, under significant pressure as global economies have continued to slow down, and the rising impacts of inflation have been top of mind for not only investors but all of those doing shopping and buying gas and doing all of those daily activities that are quite suddenly much more expensive than they were in the past. As we switch gears to the next slide, I want to remind everyone that as you have questions, I would encourage you to put those in the Q&A. We will be monitoring those, and we'll come back to those at the end of the next couple of slides. You can also put them in the chat. We will do our best to make sure that we get to all of those at the end of the presentation. So with that, I'm going to bring back in my valued colleague, Stacy Pettis, who is going to talk to us a little bit about S&P valuation and has a question for Dave and his team. Stacy?
Thanks, Matt. And thank you, investments team, for joining us as we take a look at what's been happening in the market and also look to focus on your outlook for the future. We've been watching this chart closely over several quarters, and we can see the drastic decline in valuations, which has occurred only 3 times since 2016. Historically, this may signal some buying opportunities to deploy cash that may be sitting on the sidelines. We know that our UCF balanced funds are currently allocated approximately 5 to 6% in cash. And we're wondering, from your perspective, if you can share with our investors why we use cash, how we use it, and what your team is looking for currently in terms of opportunities to reinvest at more attractive valuations. So that's for Dave, Minothi, or Lon.
Hi, Stacy. This is Lan, and I'm happy to take this question. Nice meeting everyone on the town hall. Yes, we are watching this chart even closer than you do, basically on a daily basis. Having a cash really kind of dampened the volatility of the portfolio. And as Matt alluded to on the prior slides, both equity and bond has fell significantly, double digits down year to date. The only asset class hasn't been down, and it was up actually, is commodity. Cash is being the second best asset class year to date, sadly. And the cash that we have is sitting in the money market fund, earning now close to 3%. With rising short interest rates, it will even earning more. However, have a cash is not a permanent allocation decision. We were looking for deploy at some time, and why haven't we? You're quite right that looking at this chart, back in 2018, towards December 2018, the valuation came down significantly. And then March 2020, the valuation came down significantly. And those were all good buying opportunities. They have something in common. One, there is almost no inflation back then. 2, the Fed pivot. So this, after the raising in December 2018, Fed paused. And 8 months later, they start to cut interest rate. So very accommodative monetary policy. And March 2020, if you recall, not only it was very low interest rates, almost zero, but they started gigantic QE, trillions of QE, and hence the market came back up. Right now, we have very high inflation, and Fed doesn't seem to be pivot anytime soon. They just hiked 75 basis points yesterday. And yes, their statement showing that they might slow down the hike, which means they probably will slow down from 75 to 50 basis points. And in the press conference, Powell said that it's very premature to think about pausing hiking. So Fed hasn't pivoted yet. And then we look at valuation. Yes, there is a significant correction of the multiples, which market rightly doing so, given the rising interest rates, given the rising inflation. And then what equity and the bond has reflected is the interest rate rising. So multiple comes down, and then of course with the durations, bond price come down. What hasn't kind of priced in fully is the possibility of recession and also the possibility of earning coming down. We start to see that in this quarter, even the big ones, Microsoft, Alphabet, Meta, Amazon, all disappointed significantly. So that will start, and the E may drop somewhat. Having said that, the valuation certainly is much more attractive. And then in the bear market, a good lesson is sitting on hands is tough sometimes because it is tempting to get back into the risky assets. But entering equity too early sometimes could be very painful. And you can see that chart back in 2007. We all know what happened in 2008. And then also, when we go back investing with that 5% cash, we might consider bond versus equity, because bond is positive carry. And then the expected return has increased quite a bit. And when economy recover, or when the shallow recession, bond might do well. So we are watching very closely, and then we will revisit the question next quarter.
Thank you, Matt. I'll kick it over to you to ask the next question.
Sure. Thanks, Stacy and Lon. Appreciate that. The next slide, please. So we've talked a little bit about equity valuations specific to the S&P 500, and now we want to put fixed income under the microscope just a little bit. Lon described just a little bit about the interest rate environment and the challenges that we see there, and with rising interest rates impacting the value of bonds. And one of the ways that we can measure that within our portfolios is through a term called duration, which essentially measures the or the rate sensitivity of bonds of varying maturities. And you can see on the right the impact, both positive and negative, of 1% rise or fall in interest rates. And so, again, as I mentioned before, we're sitting here with the 2-year paying us, 4.7%. The 30-year paying us about 4.2%. Curious to know from Dave, Lon, or Menothi where we see, we think we know where we see rates going from here, but where are we holding our duration within our portfolio? And understanding that bonds might be under significant pressure for the foreseeable future. Could this be an opportunity to add alternative strategies to an existing diversified portfolio?
Thanks, Matt. I'll take this one. And there's a great question in the chat, really anticipating kind of my answer, which is, with rates up, when are you thinking about redeploying capital? And as Lon mentioned, and Matt, you alluded to, duration is really the interest rate sensitivity, and we have mitigated, in 3 ways, the downdraft in bonds or the uptick in interest rates. One, as you mentioned, has been cash, holding cash in balanced funds, and indeed in our bond fund. 2, we've had, I think we mentioned this the last quarterly town hall, we have held about 10% of our fixed income portfolio in something called bank loans, which basically have no interest rate sensitivity. So again, cash and balanced funds, bank loans. And then the third aspect of this is the individual manager, lower duration, interest rate sensitivity than the benchmark. So all of those has conspired, to have added value during this downdraft. And as Lon alluded to, we are becoming more interested, and we've taken 2 tactical steps, and we're awaiting the third. So we have sold a number of our bank loans, which and put that proceeds into cash, and beginning to put it into core fixed income, yielding above 4%. And our manager, one of our core fixed income managers, has begun to creep up their own duration, now being neutral to the benchmark. So answering the question. And I think the third leg of this, Matt, will be when we decide to redeploy the cash in the balance funds, most likely first into fixed income. And we're having that internal debate now about how soon to do that. It's been a great move to wait, but we don't think we're that far in terms of price.
Thanks, Dave. Thanks, Dave, for that, and certainly appreciate that. And Carl Lehman had a question in there that, you know, our thoughts on increasing duration in the balance fund bond portfolio, given these much higher interest rates. So I think that gives a little bit of indication into our thought process as we move forward with allocation strategies. Stacy, you're up next with the final market slide for the investments team for tonight's presentation.
Great. So this slide really focuses on CPI, inflationary factors. And so we all are feeling the effects of inflation, especially as consumers. It's been decades since we've seen inflation like we currently have. What was the response of markets once inflation fears were tamped down? And then also, how are you incorporating this into the long-term investment strategy of the portfolios?
I'll start and then turn it over to Manoti, Stacy. A picture tells 1,000 words. The left side of that page is the 70s. So it really has been 50 years. I think what I'd point out about the 70s, which I remember I wasn't investing then, was really, it was a 10-year difficult time for inflation and required 3 recessions before inflation started to abate. And here we are, fast forwarding to a recent spike, and we're talking about a potential shallow recession. As many of you probably know, 1981, which was right really at the bottom of that third recession during that 72 to 82 period, really unleashed a lot of powerful forces, including bond price appreciation, which was really the start, a huge disinflationary trend, which caused a lot of mergers and acquisitions, particularly in consumer stocks. I guess what I point out is maybe, to use Lon's analogy, sometimes you need to sit on your hands and let things play out a little bit more. So we're really early in this, and I think there's a tendency to think that inflation is going to fall so quickly. That said, it has real implications for sectors of the market and for active stock picking. And maybe Manoti can just chime in a little bit about how we're scrutinizing managers and their ability to navigate in this kind of environment.
Sure. Thank you, Dave. So just to remind all of you, most of our assets are currently held with active managers. And over the last decade, as many of you probably know, the mega cap stocks really led the market, and it made it difficult for active managers who have more diversified portfolios to outperform. We expect, with the inflationary pressures and higher interest rates, that the managers that do have a more broader portfolio and are able to really know the companies in depth in terms of their cost structures, their pricing capabilities, as well as their balance sheets, can really pick out those companies within their portfolios that will shine among the others during this time.
Terrific. Manoti, thanks. Dave, thanks for those responses. And certainly this is a topic that's front in mind as Stacy and I go out and do portfolio reviews with our clients, whether that's Zoom or virtually. This is one of the first questions that we usually get is about inflation. And we know that inflation, is not just a concept to our clients. We understand that as our churches and our organizations that have money invested in us are thinking about their 2023 budgets, they're budgeting in, significantly more for things like insurance and utilities and other upkeep around their buildings and other costs. And so we certainly appreciate this information. We're going to flip over to some Q&A. We appreciate that we've gotten a couple of questions in the Q&A box. We encourage anyone to go ahead and put those questions forward. We usually try to keep this to about a 45-minute presentation, but given where markets are And given some of the concerns that some of our clients have, we want to make sure that we're answering everyone's questions, or at least to the best of our ability. So I'm gonna start, and Lon has agreed to answer this question live from Dick Orchard. Thanks for joining us, Mr. Orchard. Appreciate it. Dick has the following question: does your equity mix change during a downturn or a recession? So really referring to probably our total equity fund and our balanced funds. And so Lon, feel free to take it away and
Yeah, sure. Thank you, Dick, for the question. In the equity downturn or recession, we did make some changes, and then we made changes when the market rallied to reduce the gross exposure, because value did well this year. Value hasn't done well for the last 10 years. And then we also reduced some international EM exposure. Hope that answered the question.
Yeah, thank you, Lon. And just as a reminder to our clients, one of the benefits of investing at United Church Funds, whether it be through our managed funds and a custom strategy there, or with our balanced funds, is that we have what effectively is a multi-manager format that allows our investment team to overweight and underweight different managers based on their investment style, for example, growth to value, and then also the way that those investors will, have historically position themselves and have performed over, similar market cycles in the past. So our ability to use that lever in our investments team experience in doing that, we believe, especially as markets become more volatile on a go-forward basis, will be certainly a benefit to our clients. I'm going to call on my colleague, Matthew Illian. We have a question around ESG. And the question is this, Matthew: how much has ESG investing cost compared to overall market returns? So a kind of question that we get similarly, kind of the implicit or explicit costs of managing with our values aligned lens. So Matthew, feel free to take.
Thanks. Yeah, thanks, Matt. I think the first thing I'll point out, and then might ask Dave if he has to enhance or add any other comments. But on ESG, ESG means 1,000 different things. I mean, there are hundreds of environmental data points, social data points, governance data points, and we have lots of managers, and they're all incorporating those ESG data points in different ways to enhance their models, or to, when they're looking at these companies for good investments. So there's not really one way to talk about ESG, although it's in the media now. It sounds sometimes is looked at as this kind of one factor, is like an ESG, but in reality, it's thousands of factors. And so to the cost question, companies can purchase this data just like financial data, again, for their models. The historical, 10-year look back on ESG suggests that it can add value by incorporating this environmental, social, governance factors. But again, there's not one answer, because it's being incorporated in different ways. The other point I'll just add is we do have screens, which are a complement to the ESG, and those screens have also had a pretty positive impact on our portfolios if you do a 3-year look back. So there's maybe not one answer, but Dave, anything else you'd want to enhance?
No, I just amplify a little bit on the most primary level. Our managers don't cost more because they're doing the screening, or purveyors or practicers of ESG investing. And then the easiest way to really gauge and monitor the performance is exactly as Matthew said. We can look at our screened S&P 500 index versus the index itself. And again, the 3-year look back is that actually the ESG has added value, and it's been a little bit diminished this year, primarily because, as Lon said, what's up this year is commodities and energy. The final point that I'll make is I had a call with the Massachusetts conference with Stacy, and Minothi this week, and they own the Beyond Fossil Fuels capability. And the manager there, despite not having fossil fuels, which are up this year, is actually still beating the market. which is a good sign. So just
Thank you,
amplifying that. Thank you.
Yeah, that's really helpful for our clients, Dave. Thank you, Matthew. Thank you for that. I just had a call with a prospective client last night, asking how the Beyond Fossil Fuels Fund had fared given our underweight to fixed income, and I think they were rather surprised to know the answer, that over this year that fund has fared rather well. We do have a question out in the Q&A from a local UCC church member. Their church is considering starting an endowment, and this person would like to know maybe what we would suggest as a starting place for their investments. Without knowing too much about your goals and objectives, I'll pass on giving you asset allocation recommendations. But what I would say is this: if you're a church that's considering starting either a brand new endowment that's maybe a concept that's brand new to your church, or whether this would be a new endowment alongside existing funds that you might have, one of the strategies that we found prudent over the last handful of, well, frankly, months, particularly in this year, is a strategy of dollar cost averaging, which would be to deploy assets over a set period of time, to be able to smooth out some of the market volatility and potentially take advantage of more attractive valuations over a period of months, lowering your overall cost basis. But we would encourage you to get in touch with our institutional relationship staff so that we can have a deeper conversation about what you're trying to achieve with this new endowment, your goals, objectives, your risk tolerance, so that we can help your church walk into a long-term asset allocation that would make sense. Before we wrap up, I want to ask Matthew, Stacy, are there any? Oh, we just had another question, which we're going to go ahead and take the time. I know we're a little bit over the 45 minutes, but let's go ahead and take this. It's about our website. So we have updated information as of performance information as of 9/30/2022 available on the website. Our fund fact sheets, which are mentioned specifically in the question, typically have about a 5-week lag after the quarter close before we get that information and then publish to clients. So we look forward to providing the updated fund fact sheets as of the end of the third quarter within the next week or two. But there is 9/30 performance up on our website. That usually is put up on our website just a handful of business days after the quarter close. So if you have questions about where to find that, or if you're not finding it immediately on our website, please feel free to reach out to me after the call. I'll be happy to walk you through our website, and not only where you can find the performance information, but also where you can find other tidbits of data, so some of the many blogs and articles that we've written that can help churches understand their portfolio, understand what it means to invest in volatile times like this, and what it means to be a long-term and values-aligned investor. So, Matthew, Stacy, are there any other questions that I didn't get to? I'm seeing shaking heads, so it looks like we're clear with that. We wanted to make sure, again, with the market volatility, that we were answering everyone's questions. And if there are questions that arise after this event, feel free to reach out to either Stacy or I or Matthew directly, and we'll make sure to get you answers just as soon as we can. In closing, I'm looking through the roster of attendees for this webinar, and we really appreciate everyone's time. And I'm noticing that we have clients represented on this call from the East Coast, the Midwest. I see folks from the West Coast, like Palo Alto, and I even see some of our friends joining us from the Hawaii conference. And it just reminds me that at United Church Funds, we have a mandate to serve the entire church, both by geographic proximity to our office, but also whether you're a large church or a small church, whether you're just starting out and trying to manage and create an endowment, or whether your church has been blessed with significant assets for 100 years or more. We're here to serve you. We're here to provide you with this competitive platform, and we're really appreciative of your time and for the opportunity to be a trusted partner to your church or organization. So with that, I want to thank my colleagues on the call. And again, thank you all for joining us. We hope you have a lovely evening. And again, don't hesitate to ever reach out to us should you have questions. Have a great night, everyone.